Okay, let's get straight to it. Not going to waste any time. This is Jim's Power of 3 Mastery Part 2. Before we get into the details of all the Power of 3 models and all the Power of 3 stuff I look for every day, I need to teach you guys about narrative, bias, and time. Okay, so let's get straight to it. I'm going to put my webcam here. Just going to lower my camera a bit. Okay, so that should be out of the way now. Okay, focus on my cursor here. So smart money, narrative, bias, and time. What's the importance of this? Okay, you need to understand these three concepts in the context of smart money, okay? Not dumb money. We don't want to trade like dumb money. So yes, we are retail traders. I know everyone always says like, oh, we're all retail traders. The idea is to trade opposing to that retail idea. Yes, we're retail traders, but we can still trade with the mindset and perspective and context of smart money. And that's what we want to do. We want to know how smart money is positioned or how smart money will position, as well as understand how the algorithm is designed to deliver price. And we can identify the higher probability conditions to trade in and the time in which the market will deliver using bias, narrative, and time. Without bias, narrative, and time, there is no power of 3. It's pretty much useless. So you need to understand these three concepts. So first things first, what is bias? Very simple. Bias is when you, as a trader, have a prediction or a preference or a speculation, anticipation, whatever you want to call it. You have an idea of where the market will trade to, one-sided or the other. You can't be bullish and bearish. You can't say, I think it's going to go up and I think it's going to go down at the same time. You need to have one favored side. Your three options are you're either going to be bullish, either going to be bearish, or you're going to be neutral. Neutral meaning you don't have a clear bias, and that's okay. Okay, so that's just a clear depiction of what bias is. Now, what is narrative? Okay, narrative is knowing where price will move, so bias, but also understanding why it should move there. The story behind price. You hear a lot of people talk about the story. That's what narrative is. Why should price go there? Just because you're bullish, okay, why should price go there, right? Is it to run a pool of liquidity? Is order flow been constantly bullish and you think price is expanding to a specific target? Is there an economic calendar event where price is expected to move aggressively, right? Is there a huge imbalance that price needs to come back to offer fair value or discount pricing? What's the narrative behind price? So to do narrative, you're going to look at time and you're going to look at price. That's the two things that will compose of your narrative. And when I say price, we're talking about PD arrays, okay? We're trading the algorithm, we're trading ICT. So when I say look at price, I'm talking about the PD arrays, talking about highs and lows, imbalances, and all your other PD arrays, okay? Now, what is time? Obviously, time is time, but the algorithm runs on time. In order to determine your bias and narrative, okay, price slash PD arrays. So your PD arrays, when you say, look at this fair value gap, or I think we took all of that is useless without the premise of time, okay? It is time that activates the PD array. Everyone always asks, man, the number one question I get asked is, Gatie, which breaker block, bro? Which fair value gap? Which high or low? Your answer is time. The one we are trading at during the time that we're expected to expand or anticipated to expand, right? If you're expecting distribution, what if I told you tomorrow at 10 a.m. we're going to move, okay? Well, you'd be looking at the PD array that we're trading in at that time, right? So it's time first, okay? So to understand time, right, we're looking at time-based price levels, okay? I know a lot of people say time-based liquidity, but there's also imbalances. So it's not just about your previous day high, previous day low, your session highs, right? There's also your opening range gap, your new day opening gap, and stuff like that. You also have your kill zones. Time also plays a component with the economic calendar. You also have opening prices, and you also have macros. And we'll get into those stuff later. Okay, so when you're determining your bias, so moving back to bias, when you're determining your bias, your goal is very simple. You have two goals when you say what's your bias, okay? Actually, I'm going to make that 3. Okay, 3 goals. Your first goal is to understand, is there a clear bias or is there no clear bias? If there's no clear bias, then why are you trading? You can't even have a clear prediction of where it's going to go. So why are you trading? You're not trading a good condition. So you wait for more information. You don't need to have a bias, but you want to wait until you have enough information to at least say to yourself, you know what, I'm favoriting this happening. So that's your first goal. Is there a clear bias or no clear bias? Then you have to understand, is your bias bullish, bearish, or neutral? Sometimes it's just not clear, right? You're going to look at the chart and be like, bro, I don't fucking know. It's not clear. So no bias. You're neutral. That's okay. You can wait for more information. Don't trade that day. Skip it to another session, whatever it may be. You just need to understand that, okay? And then your third goal is to, and this one, people always forget about this, but this is very important. You need to understand or anticipate, is today or is this session or is this time likely to be expansive or is it likely to range, right? Is price going to expand towards a higher time frame objective, or is price going to likely stay within a range throughout the session, throughout the day, throughout the next 30 minutes, whatever it may be? Because sometimes people say, oh, the daily chart's bullish, so I'm bullish. But then they look at the intraday charts and realistically, it's not primed, right? The time aspect and the economic calendar and the narrative that's being framed within that trading session is primed to range, right? Prices, the real narrative of price is staying in a range, right? Price is being held. That's the story at that time in some instances. And you need to identify that, because if you're looking to hold trades or take longer position trades, you're going to get chopped up. You're going to lose the trade because you're expecting an expansion, but that's not the story, right? You're on a different page. You're not on the same page with the market. We always want to think in the context of smart money, okay? Is smart money distributing for positions to be distributed, right? Is price expanding so smart money can distribute their positions? Or is price being held in a range so there's no clear fluctuation because they're waiting for something else, right? I know I'm talking fast, but I don't want to waste any time. So we're getting straight into this, right? I got a lot to cover. So your goal is to identify the bias when it is clear, right? Because imagine you came into a session and you said, you know what? It is so clear to me that we are going to trade higher. It'll be very easy for you to find a long setup because you know exactly what to look for. You know it's going to go up. So how easy it is going to be to find a long setup, right? You can almost trust any setup that forms within that session, as long as it's a long setup, right? And when I say setup, I'm talking about entry models, right? If you're bullish and you really trust your bias because it's just so clear, your long entries can be very easy to find, right? So that's the kind of goal. And now, the last thing I'll say is you do not need to identify every time, okay? It doesn't matter if you go days or weeks without a clear bias, right? Your bias developing skills and narrative developing skills will improve, but the important part is to every day, every session, go with the mindset of, okay, do I think it's more likely to go up or more likely to go down? Or is it not clear and do I need more information? That's what you need to do. It's that mindset. And when you go to do that mindset, you need to keep in the idea of the smart money narrative and understand the context. And I'll talk about that more throughout this. This is just an introductory page. For narrative, your goal is to understand why your bias should play out, okay? Just because you're bullish, because you can't say, oh, I'm bullish because we're in discount, right? Why? Why should we go to premium, right? Why, right? Is there a narrative where smart money is looking to distribute positions? Is it a range day where you're expecting price to range up and down? So now that we're in a discount, you're expecting it to go to premium because, well, the two options are it's either going to consolidate or now go to the higher portion of the range. Remember, you're not expecting expansion, so you're expecting a range, right? So that's another idea. This is what will help you frame and trust your bias. And then the final aspect of time is just understanding why and when it'll play out. So first idea of this whole page and what I want you to take away is, what do you think is going to happen, why it should happen, and then when is it going to happen, okay? That's kind of the idea of this page. All right, let's move on to the next page. So revisiting episode 1, we talked about this in episode 1. Why Power of 3? Power of 3 will put all of these components together in a framework that can repeat every single day, and I will cover this in future episodes. Like I said, today we're not talking about the PO3 frameworks. We're talking about bias, narrative, and time. So what do I mean by Power of 3 will put all these concepts together? Well, what I mean is Power of 3 can help you get bias, narrative, and you can use Power of 3 in conjuncture with time to figure out your distribution move, right? So this is all stuff that was covered in episode 1, but just revisiting this, that's why we're talking about smart money narrative, bias, and time, okay? So to the next page. So to talk about bias, okay? How do I determine bias? Weekly Power of 3, and I should also include monthly in this. So I have a video on my YouTube channel, and it's the video is called How I Determine Bias with High Probability. I honestly don't think I can make a video better than that. I also have a video on how I use highs and lows, how I use imbalances. I'm probably not going to make those videos again. I cannot do better. So I will link it in the description and you can go back and see. So how do I determine bias? First of all, monthly power 3, weekly power 3. When I say weekly power 3, I'm talking about weekly profiles, okay? And then daily power of 3, so I'm looking at daily profiles. How do I look at the daily chart? I look at liquidity, right? How price is moving or potentially expanding or rejecting off of liquidity levels and imbalances. Okay, so liquidity, imbalances, and the last thing I look at is order flow. So is order flow bullish? Is order flow bearish? Ideally, you're not trading against order flow. Then you get to more counter trend idea. Then it gets more difficult, but there's always that, right? So that's all I do. You know, I look at power of 3 on the higher time frame, and then I look at my key highs and lows and key imbalances. So again, I'm not going to go into all of these right now because this is a Po3 Mastery. This isn't a teach you everything I know about trading mastery. This is focuses Po3. I just need to get this part out. So if you don't understand what I'm saying when I say daily power of 3 or order flow or liquidity or imbalances, I have videos on my YouTube channel that are called How I Use Liquidity, How I Use Imbalances, and How I Determine Bias. Those videos are going to teach every single one of these. I'm not going to do that right now. Okay? Then you have bias. We talked about bias. Now we talk about time. Time, one aspect of time are macros. Okay? Your Po3 that we're trading, a lot of the time macros are going to overlap when you're expecting distribution. So what are macros? Macros are a time interval that are x50 to xx10. So for example, 950 to 1010, 1050 to 1110, 1150 to 1210. Okay, there's no 920 macro, there's no 940 macro. I don't know why people made those up. Okay, these are ICT's macros, right? He gave us these numbers. He said go back and study these times and look what the market does, and I did it and many other traders did it, and it's very accurate. There's no 920 macro. Okay, people are just changing it. There's no 940 macro, there's no 945 macro. The macros are as ICT gave them many years ago, and they're the same today. It's any time that ends in 50, so 10 minutes before the hour closes, and then 10 minutes after the hour opens. Every single hour of the day. Okay, the only exception is the final regular trading hour, which is from 3 p.m. Eastern time to 4 p.m. Eastern time. That whole hour is a macro in itself. It's called power hour. Okay, those are your macros. What do you expect in a macro? I'm only going to say this once. During this time, okay, I'll type it out so if anyone wants to take a picture, you can take a picture. During this time period, interval, whatever, you anticipate. Notice I didn't say it will or it's going to. You anticipate. Prepare yourself. Okay? Anticipate a price run to liquidity or inefficiency, whatever. All right? So imbalance or liquidity. That is it. Expect the market to move. Okay? Expect an expansion. And when I say expansion, I don't mean, right, just expect this all the way one direction. That's not what I mean by expansion. When I say expansion, what I'm referring to is any type of move besides consolidation. Okay? So this is consolidation and this is expansion. So any move that's not consolidation is expansion. And we're going to get into that on the next page. Bear with me here. Expect an expansion move. What does that mean? It means it could be a retracement. It could be a reversal. It could be an expansion. Just a simple expansion from consolidation, right? Expect it. Where is price going to expand to? There's only two things that price can move for. It's either liquidity or inefficiency. So look out for those key levels. The idea of the macro is most of the time you'll see that it'll distribute your position during your macro. You'll see your setups play out or form within that time period, okay? That's it. That's all it is. I'm not going to cover it again. Time-based PD arrays. So we talked about on the first slide, what is time? I said time-based price levels. What are those levels? Previous day high, previous day low, previous week high, previous week low, previous month high, previous month low. Why are these key levels? Because it is the high. So it is the price level, right? At the specific time. So from this time interval, that is the highest high. So therefore, it is a very key level because it can be referred to algorithmically by time. and then previous session high and low. Then you have your imbalances that are also run by time. You have your new day opening gap, your new week opening gap, and your opening range gap. I'm not going to cover what all of these are, right? This is a Po3 Mastery, like I said, but just knows that these levels are also referred to algorithmically. You don't need to use every single one of these. Just know that when I say time-based PD arrays, these are your time-based PD arrays. And there's more. These are the ones that I use. The last aspect of time we're going to cover in this little context, this little portion right here is the economic calendar. The economic calendar will tell you whether the trading day is a trade day or no trade day. What does that mean? It means some days you expect not algorithmic delivery. Okay, some sessions, some days, some portions of time you expect to it not be regular algorithmic delivery. You're expecting a manual intervention, right? It may not occur, but you expect it, you anticipate it. So why would you trade when it's literally someone putting their hand in the market and picking what's going to happen, right? There are no algorithmic signatures. So it would be strictly gambling if you are trading during a time where you're expecting manual intervention. You do not trade during manual intervention. How do you know that? The economic calendar. That is the easiest way for manual intervention to occur. Next, the economic calendar can also help tell you if it's going to be an expansion day or range day. Because on expansion days, usually there's some sort of volatility injection, right? The volatility index will increase because there's a volatility injection in the market in the form of economic events, okay? The last thing is whether it's high or low probability. And what I mean by that is it time to expand according to the economic calendar? For example, if it's Friday, NFP, right? You have Friday, non-farm payroll event, one of the biggest economic calendar events every single month, and it's on the Friday, right? Would you expect an expansion move on Thursday? Would you expect a one-sided expansion? Why would you expect that? Don't anticipate that on the day before a non-farm payroll. Why? Because you're expecting that expansion to occur on Friday. So why be there on the Thursday when it may not happen, more likely to not happen, but you know on Friday that it is going to be. So that's more high probability in your favor, okay? So that's what we're referring to when I say bias in time. I'm not going to cover every single one of these, but like I said, the bias portion, it's already on my YouTube channel. I made really good videos. I don't think I can do better. I probably could do better, but I don't need to. Everything you need to know is there. So next, the interbank price delivery algorithm. This is where people are going to probably start learning something. Narrative and bias in the form of the interbank price delivery algorithm, IPDA. Okay, IPDA refers to the stages of price delivery. It can be used in pair with time to determine bias and narrative. What are your 4 stages of price delivery? Now, what I referred to earlier, I said price can move for 2 things: inefficiency or liquidity. Only 2, right? Forget everything else, not equilibrium. Sure, it'll move towards equilibrium, but what it's really moving towards is a imbalance or liquidity resting in equilibrium, okay? Those are the 2 things price will move for. How is it going to get there? These are the 4 stages. These are the only 4 ways price will be moving in a stage, right? What are the 4 stages? Consolidation. Most people know what consolidation is. This is consolidation, when price is within a range, okay? The next move. Now, most of you may not know this. I'm going to just change this up to make it more appealing. So these are the 4 ways. So identifying this can be very, very crucial, very, very helpful on each time frame. So consolidation is 1, right? Expansion. Why did I put expansion number 2? Let me tell you why. Because after consolidation, the only thing that price can do is expand. Once price is done consolidating, the next thing that is going to happen 100% of the time is there's going to be an expansion move. Now, I'm not saying distribution. I'm saying expansion. I'm saying price is going to end consolidation, okay? It's going to move in a direction. It may be a fake move. In this case, it's manipulation. That's why the next potential thing that can happen is either going to be reversal or consolidation. So after price expands, what can happen, right? What can happen? You're going to get reversal or retracement, and you can also get consolidation, but we're going to be looking for, let's say, for example, in this drawing, reversal. Okay, so price is consolidating. We see expansion. What after expansion do we expect most likely? It's usually going to be either reversal or retracement. It's pretty rare that we are going to consolidate, expand, consolidate. Yes, it's not. I shouldn't say it's pretty rare. That's a mistake. This does happen quite a bit. But what I want to focus your attention to is when price expands into a specific time and specific level, you want to focus your eyes on potential reversal or retracement, okay? And that'll make sense as we continue this series. Okay, so we have consolidation, we have expansion, now we have reversal. Now what can price do after reversing, right? After reverse, price is now reversed. It's either going to consolidate or retrace. That's very simple. Now this retracement can also be a reversal, which is also viewed as expansion. But for the purpose of this depiction, let's just say we retrace, and then after retracing, we consolidate. What do you expect after this consolidation? Potentially expansion, and then maybe reversal, and then maybe retracement, and then expansion. So this is expansion. This is not reversal, because this is retracement, right? So identifying whether or not we're retracing or reversing. Now this is very important. And the reason I'm teaching you guys this is because the frameworks and the models, the A+ models, the one that everyone's waiting for me to leak, you need to understand the phases of price delivery. Because when I say, right, you're looking for an accumulation, and then at this point right here, you're looking for a retracement or reversal, you need to know why and what you're looking for to identify which is happening. So the first purpose is to identify the 4 stages of price delivery. You need to understand when it's likely to reverse or retrace. And you need to understand that when we're consolidating, expect an expansion move, okay? This is the premise of every single power of 3, okay? Every single power of 3 is implementing this idea. So this is very, very important. That's why I'm teaching it. This will also help you determine bias and narrative, okay? Very, very good. So now that you guys understand everything that's on this slide, for the most part, we're going to do a little activity here. Pause if you want to pause. What I want you to do is take this picture. So you can do this. Take this picture. Okay. And now that you have this picture, all right, I want you to go to your trading view and draw out the retracement, reversal, expansion, and consolidation. So I'm going to do it live with you guys, but you guys can do this as an activity to practice the IPDA and the stages of price delivery. This is a 4-hour chart from, I don't know, August or something. It doesn't really matter. You can do it on the 1 minute. For the most part, when I do this, I'll be using it on the 1 minute, right? Because I want to determine when that reversal is coming, when that retracement is coming. So for example, we'll start right here. So look at my cursor. We're starting right here. So we have consolidation. And then notice this consolidation, we have this little expansion move down, right? This is from here to here. This is not consolidation. That's a one-sided move. So let's draw that out. And you know what? First, just to make this good, let's mark out all the expansions with blue and all the consolidations with black. So you have consolidation, then you have expansion. And then what is this move right here? Well, if we had expansion down and we have expansion up, so this is reversal, all right? So we have a reversal. Let's mark that reversal with, let's do orange, okay? And then we have, what is this? Consolidation at the high, right? 1, 2, 3 candles, that's more than enough. So we have a little consolidation, all right? Then we have expansion, right? So let's go mark that with blue again. So just this little activity. You have expansion, so let's mark that out with blue. And then what is this? You have a retracement. Let's do retracement as purple. You have a little bit of consolidation. Go with black. You have another move down, so that is expansion, right? Now it doesn't need to take the low, it's still This is no longer consolidation, right? We're expanding. So we expanded. Expansion is blue. And then what does this move up? You have a little consolidation. You see that? 1, 2, 2-ish candles that stayed in consolidation. And then you have expansion again with that this move higher right here. So let's mark that expansion with a blue line. And it's good to practice this so you can get used to it. Then you have consolidation again, and then you have expansion, consolidation, expansion, consolidation, and then here we are. And if you keep going, expansion, consolidation. This is expansion. You have to view this, is this expansion reversal or retracement? That's where you would use your thing. In this case, it looks like a reversal. So we have reversal, retracement, expansion, consolidation, expansion, retracement, consolidation, expansion, consolidation, and then probably expansion. Again, you can see how this delivers very, very systematically and very, very effective in determining your power of 3. The reason I'm teaching this now is because the next episode, I will be covering the power of 3 at 9:30 that we are trading. You need to understand these phases. So the takeaway from this video is understand bias, which is what is going to happen, narrative, why it's going to happen, and then time, which is when it's going to happen, and what you're looking for each of those things. If you have trouble with that, there are videos on my YouTube channel. You can watch other people's YouTube videos. It doesn't matter to me. You can watch ICT's lectures. That's where I learned all of this information from. All of that will help you with these 3 things. The thing that will help you most with bias, narrative, and time is practice and tape reading, or watching someone who's tape reading. The reason is because you need to be live in front of the candles and the charts of watching them paint. You need to say, okay, because this happened, I think it's telling me this. Therefore, I think this is going to happen potentially at this time because of this reason. Those are the kind of things you're thinking about, right? So for example, just a very quick example, right? Let's say, okay, order flow is bullish. I can see that. I see that we took out this sell side level. I can see that maybe we put in an SMT here. So this is kind of telling me that this might be a retracement, and then we get expansion higher again. Where could it expand to? Why would it expand? Well, price is already in bullish order flow. It looks like smart money's positioned long, distributing positions. This looks like a retracement move to then put on more positions to deliver towards that target, that distribution target being all-time highs. It's also the time of year where there's elections and we're expecting all-time highs during that time or higher prices in that time, right? It's also November, December, seasonal tendencies are usually higher. You can see the confirmation in price, the inversion fair value gap. We expanded, we got the change in state of delivery, yada, 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 that kind of stuff. So because this happened, right? That's kind of the narrative. You can't really teach someone how to do a biased narrative and understand time. You need to go through it every single day, look at the charts, see what's happening, understand why it's happening. My advice to you is watch ICT's lectures or watch someone do it live in front of you. I think that's what helped me most. For me, was ICT's lectures, right? Because he went live and he did it. And I feel like that's where I developed most of my skills. So with that being said, that's everything for this video. Next video will be Power of 3, 9:30 Power of 3 Masterwork, right? We're going to cover the A+ model, the entry model, what I'm looking for, and the different ways the Power of 3 can form in a very clear context, okay? And we'll give a lot of examples as well. That being said, GatieTrades is out. Hope you enjoyed the video. Peace.